Welcome to the Independent Dealer Podcast with hosts Luke Godwin and Jeff Watson, a podcast by dealers for dealers. Here we go.
Hello and welcome to the Independent Dealer Podcast, brought to you by Buckeye Dealership Consulting. Today we have Mr. Shawn Richardson out of Oklahoma. Really excited about this one because Shawn is a dealer that I look at and I say, man, hopefully someday that is where I can get to. I mean, with the caveat of more money, more problems, and maybe Shawn will tell us a little bit more about that. But Shawn, introduce yourself to the podcast community and give us your quick 0 to 60. You know, your business model, where you at, what do you do?
Well, I'm an Oklahoma buy here, pay here dealer. All we do is buy here, pay here, no retail. I've got 5 retail locations, 4 in the Oklahoma City metro area and 1 in Tulsa. I've also got a separate warranty department in Oklahoma City. And then I also have a separate corporate office for administration and finance in the finance company.
That's interesting that we're going to dig into all of this. And Jeff's like, yeah, I look at him and go, I want to be that. That would make me throw up that I would have all that to deal with every day. You know, don't get me wrong. What you've done, Shawn, is amazing. And I did have that thought in the back of my mind. This is the way I want to go. But man, I tell you, after this past year, with all the struggles that we've had with inventory, with employees, I'm at a point where I'm like, I just want to shut it down. I mean, do you ever feel like that every once in a while, Shawn?
All the time.
Okay, just as long as I'm not the only one here. So Shawn, let's start at the beginning. What year did you open? And it's let me get this right. Express Credit Auto, correct?
Correct.
Okay.
We opened in November of 1996. So this is our 25th year in business. And it was my dad and I. We were the operators. And then we had another partner that we brought in for additional capital. And now my dad's retired and living his best life in Florida.
That's what everybody does, retires and goes to Florida. No wonder there's so many cars down there, low mileage cars. Well, Shawn, if in 1996, when you opened, were you strictly buy here, pay here then, or did you look at it, hey, I'm getting into the finance business, or did you look at it as getting into the car business?
I always did a few notes, but it was always a sideline business in the beginning. Mostly, you know, the lenders were so aggressive back then that we did third-party financing allowed other people like Jayhawk Acceptance, Credit Acceptance, and a handful of others that aren't in business anymore. But that was where we specialized. And then I could tell that it was the lenders kept tightening up. Funding was getting slower and slower. And I could just see the writing on the wall that, hey, this loose lending party is about to implode. And so that's whenever I started pivoting to buy here, pay here.
What year do you think that was when you decided, hey, this is where I'm going and this is how we're going to do it?
About 1998, because
And that's, you know, I was starting to get more involved in the business in 98. I was in college and my dad had been open since 85. So I don't recall, you know, because we were already at that point pretty much 100% buy here, pay here. I don't recall there being a wholesale switch in lending. It seemed like maybe, I guess you're saying 97 or 8, it started tightening up. But I recall, you know, in the early 2000s when everything started loosening back up again, was there a period from 98 until, you know, mid, I guess, early aughts that it was tight that I don't recall?
Yeah, it was. The deep subprime buyers basically disappeared and they didn't come back. It's never been that loose since.
That's interesting because you think of, you know, the time from 05 to right before the Great Recession. We think about how loose the capital market was then. but you're saying it was even better prior to that, which is super interesting.
Yeah, they were basically financing deep subprime customers without proper verification and things like that, based on what I view as proper verification. You know, they were basically a driver's license and a credit app, and we could get people funded.
Yeah. So Shawn, when you guys decided you wanted to start carrying stuff in-house, and you saw the writing on the wall, how did you get started with that? Because I think a lot of dealers might look at that and say, hey, great, yeah, you know, I can sell through CAC and some of these other guys, but if I really want to start doing some buy here, pay here, do you reach out to family and friends and start borrowing money? Do you go out to the big lenders right off, or how did you do it?
Well, we just fought through it with our own cash flow. I was young, and back in 1996, I was 21 years old and was living in a mobile home and didn't have kids. And my wife is, you know, very easy to please financially. So, you know, I just reinvested every dollar. Back then I could live on $1,500 a month. So we just took all the money and reinvested it back into the company. And I know that's not an option for most people, probably hardly anyone. But for me, it was one of my saving graces, because also I understood the power of compounded interest. And I knew that if I just kept reinvesting my money, that there was going to come a day to where I'd make more money than I'd ever want to spend.
Shawn, that's an interesting take, because that's exactly what my dad did. And I mean, it's paid off. We don't owe anybody, anyone, you know, anything. And it is a very interesting take. Do you believe, with the current price of the cars, that you could redo that model? I think that, you know, when my dad started buy here, pay here, you know, cars were $500 to $1,500, and he was getting, you know, $500 down or whatever. And I mean, don't get me wrong, it was super tough to do it then, living, you know, reinvest in everything. Can it be done today with the price of cars compared to then?
It can, but not in scale. And it was easier to do it in scale back when I got started on a cheaper car. But now it's just a knife fight. You know, the guy's just got to go to the auction, probably live auctions, and fight it out on finding those more affordable cars that people are neglecting. Maybe they need a little more repair to get them ready for sale, things like that. But absolutely, I mean, you can still buy cars for, you know, $3,000 to $5,000 and note them out. It's just, I don't think you can do it at any scale, but getting started, absolutely.
When do you think that, when do you think that magic number has to switch from getting started to going to scale? I mean, do you have an idea of that anymore? Like, is it 400 accounts? Is it 800 accounts? Do you know if there's a limit?
Well, the problem with that lower end car is that you're going to attract the highest risk customers, and they're going to have the worst severity on your repossession rate. So it's going to be hard to build a portfolio in that business that's sustainable. It's going to liquidate really fast. Probably within 18 months, you'd have 75–80% of your sales off the books. But with that being said, it is a high cash flow business, though, on that lower end, where the cash flow comes back really quickly, is what I mean by that. So it's just one of those businesses to where I think that the number, I don't know about the number of accounts, but it's probably around 40 to 60 a month is realistically in sales volume, all that you could probably realistically do. But that depends on if you're rural or urban. You know, there's a lot of variables.
Down payments.
How many auctions you have around you.
Shawn, so for you, the evolution of your dealership, when did you guys start? I mean, I want to know, when you started to scale? When did you start adding locations? I think, you know, you've got 5 retail locations, and I mean, just doing some crazy stuff. When did you start to scale that out? Was it a certain amount of notes, a certain amount of cars, or did you have kind of a growth and game plan that you said, hey, I want to have this many notes under collections and things like that? How did you get there?
I just ran hard with my foot against the gas pedal. I didn't really have those kind of goals. Sometimes I think people spend way too much time planning. Planning is important. You need to understand your cash flow and stuff, but you need to be able to do it on a napkin. You don't need a 10-page spreadsheet on, so people spend too much time thinking about it. And what I was doing was whenever opportunities would arise, I would look at my cash flow, take a gut check on whether or not I was willing to do that work and hire additional staff. And if everything said green, then I went. And so I've always been very opportunistic, and I try not to force things to happen. So with opening stores and things like that, I've done that once, and it's been a struggle because the store just costs too much. The store that I did force to happen in a lot of ways compared to the others, where the opportunity just kind of fell into my lap and it was a great deal. The one that I forced is the one that's temporarily closed right now. I can never get the volume up to where I wanted it. It holds easily over 100 cars. Its average monthly sales were 55 units, and its rent factor is $30,000 a month. So, but I thought, I got to have a store in Norman to complete my puzzle. And did I really? I don't know.
Well, Shawn, that's so good for people to hear, because what you find is, as car dealers, and maybe other business owners, but I can speak as car dealers, once you feel like you have something that works, you want to force it. You want to do it again, right? And maybe it's better to wait for the opportunity, wait for the right piece of property, wait for the right deal on the right piece of property to do that. So in 98, you said, okay, we're going to do buy here, pay here. What year did that second location, the right opportunity, come to you?
I don't have those timelines in front of me, so I'm just going to go based on my memory. It was about 3 or 4 years. So 2021, 2022, we opened up our South Oklahoma City location. And then in about 2006, we upgraded. We moved out of our original location and moved to a 5-acre facility that was a Nissan store, 25,000 square feet, 5 acres, and then a detached 10,000 square feet. So that was a big move for us, and that put me on a huge growth mode. Having reconditioning in my corporate office and a high volume store under one location, it's just so easy to run compared to everything else I've done.
And how many units do you sell out of that location a month, do you think?
Well, right now we're COVID hobbled. So
aren't we all?
Right now it's not that great. Yeah. But typically it was 125 to 150 units a month was its range before COVID. Now with COVID, I've been unfortunately, I was leaning into defense through COVID. That was a mistake. And it's kind of ground my volume down to that store's doing about 60. So
wow. Yeah.
It was a huge mistake playing defense through COVID.
That's playing defense during COVID. I felt like I was playing offense for a bit, and then I got put on the defensive. Do you think that's opposite with you? I felt like I played offense early, and now I'm playing defense.
Yeah, first when the inventory prices melted down and Hertz was going bankrupt, and we just had a ton of inventory available, I was gobbling it up and doing well. And then I got it in my head in January or December of last year, December or January of this year, that hey, the market's these high prices are going to drop in 6 months. Mm-hmm. So then I started playing defense, and then I got to May and I was like, oh, well, my timing was wrong. Prices are going to drop in 6 months.
You and I were looking at the same crystal ball, just to let you know.
Yeah, Luke's is
yeah. And now I'm like, heck, I think they're still going up, and probably for the next 2 years. So, but I've had to let it go. It caused a lot of unnecessary stress with me trying to time the market, so to speak. I should have just floated with it. I should have just replaced what I sold, focused on the inventory that works for us. And I should have just not put too much thought into it. I should have just floated with it.
There's definitely something to be said about having a short memory in the buying process, right? Because you look at the cars that I bought last year. Well, if I had just held on to them for an extra 12 months, I would have made 3 times as much as I made 12 months ago. But I'm paying $3,000 more for the same car that I retailed 12 months ago. But you just can't play that way, right? You got to look at, okay, what does it cost me today? What can I sell it for tomorrow? Great, quick turn time. Even in the buy here, pay here industry, I don't always look at turn time. I don't care, but it's still pretty important.
It matters.
Yeah, I think right now, I think turn is important because I don't think any of us want to get caught in the potential bubble burst, especially if people are flooring inventory.
Mm-hmm.
For those of us that have cash inventory, cash paid inventory, I think that, we could take more risk, but we all need to be cautious to a degree.
Yeah, Shawn, let me ask you that. So I could imagine you got, let me take a stab at 2,000 accounts on the books. How many accounts?
Or not?
Don't mind sharing.
8,400.
Yeah.
Way off.
Yeah, you were way off, buddy.
I don't even know what I'm thinking. So Shawn, but here's what I'm drawing the picture of. I know that when COVID hit in March of 2000, whatever it was, 2020, I panicked, right? Because I'm like, oh, I could have a couple hundred cars show up on my doorstep tomorrow. You're thinking I could have a couple thousand cars show up on my doorstep tomorrow. So when COVID hits you and those things happen, it's amplified by 8,000 times what a dealership like me deals with. But on the flip side of that, also, you're looking at your asset, your portfolio as an asset and thinking, well, geez, those cars are worth a lot more now than they were 12 months ago, as far as like my collateral recovery rate has gone up because I've almost welcomed some repos right now. I wish I could find some just to get those cheap cars back in my inventory. Has that affected you at all?
No, because I knew that the loans would perform better. Our loans always perform better in crisis, always.
That's
Customers get scared and they make their payments. Our loans perform worse when the economy's booming. Our loans perform better in crisis. It's always been that way.
It definitely. I remember back in the Great Recession, that's exactly what happened, and I always thought that was going to happen, but then I didn't think about the COVID being the crisis that it has become. I guess and in the beginning we thought it was going to be a very short-lived, maybe 2 or 3 months that was going to wreak havoc, and then maybe we could try to get back to normal. But it's drug on as long as probably the Great Recession kind of did. But yeah, our loans have always performed better because it's harder for people to get cars. But then when they pump the cash into the economy, it kind of screwed everything else up too.
Yeah.
Shawn, how many employees do you have when we're talking about 8,000 accounts, 5 locations, recon, warranty center? I mean, you must have 200 employees.
Yeah, I try not to get there, but it's typically 140 to 160. We're beefing back up, and we're closer to the 160 number right now. I've just decided that I can't keep playing defense. It's been the wrong move. But we've been staffing up. We've been gearing up our advertising, and I believe that this next tax season, as far as the amount of tax dollars available per sale for down payment, is going to be the highest and best we've ever seen in our lifetimes.
Mm-hmm.
That's exactly what TaxMax told us. Isn't that right, Jeff?
Yeah. They definitely have done the math and they know. So it's always funny when you get in and you hear dealers try to chime in and give their 2 cents about how tax is going to be horrible because this or that. You're like, come on, man, just listen to the professionals. Don't try to be the Nostradamus yourself. Let's go to the people that know. Hey, since we're talking about taxes and tax time right now, make sure you are signed up with TaxMax. It's the end of December. It's not too late to get signed up with TaxMax. Use our dealer code to get 20% off of your sign-up fees and start filing those taxes and deferring the down payment.
Yeah, and don't listen to all these other dealers out there talking about there's not going to be tax money. There's not going to be tax money. We heard it from a legend in the buy here, pay here business. It's going to have some tax money. He's planning for the biggest tax season of all. And TaxMax told us that 2 months ago, Jeff.
Yep.
Get ready. It's coming. There's going to be a lot of money.
Yeah, I've already done 5 deferred down deals just for some preferred customers that we have, to the tune of, I think, $6,000 or so,
Awesome.
$7,000. So I'm already getting my hands on some of that money, pre-filing their taxes. So it is time. Get at it now.
Mm-hmm. And Shawn, when it comes to how are you preparing this year for tax season? You talking about revving up? Are you going into the lane and buying cars and just paying what it takes to get them? Have you started sourcing differently? What do you think is different this year compared to last year when you look at that, or compared to years prior?
Well, we're still trying to get those cheaper cars. For us, the auction value would be $8,000 to $12,000. Those are the hardest cars to get bought that we're after. It's right. There's been a little bit of a dip in the trucks that we purchase, maybe by about $2,000. So we bought a whole bunch of trucks lately, about 200 of them, to get ready for tax season. So where I'm putting my bet or my investment is in trucks, and we're going to try to move a lot of trucks this first quarter.
Shawn, if we look back maybe 5 to 10 years and we start talking about drive time, when drive time showed up in my area, I really thought that they were, a competition. They're here, they're going to be big competition. And for someone like you, who's, as big as, not probably nationwide as big as drive time, but in your area, you probably beat drive time from day to day. Can you talk about the evolution of maybe all this corporate money coming into our industry and how you've fought it, and what do you see happening in the future when it comes to drive times, United Auto Credit or Carmart or whatever? What do you see going on there?
Well, we need to pay attention. They are more innovative on digital sales. They're more innovative on buying direct from the consumer through Carvana. So we need to pay attention and learn. They're also really good digital advertisers, and their messages on their ads are really good. Drive Time's landing page is really good for generating leads. So we need to watch them and learn, and borrow their best practices for ourselves. So, but we have an advantage, and that is we're the local guys. Trying to take care of a problem with Drive Time or Carvana, you can just look at their reviews and see, look at their 1-star reviews. And it is just those poor people. They just can't hardly get to the right decision maker or the right problem solver. Mm-hmm. And not only that, but I haven't seen any Drive Time or Carvana support for high schools, junior highs, the baseball teams, the soccer teams, and all of that kind of stuff. So we really need to beat the drum on who we are. We're the local, community-driven dealer. And if you want to deal with a digital dealer, then good luck.
That's an interesting segue, because when we first started this, you talked about having a warranty department only, which I think is such a creative idea. I've never even thought about it. And I assume you have your own reinsurance company. So can you walk us through how you've set that warranty department up? How many people are staffed there, and how do you handle all that volume? Because I see on your websites you have a 3-year 36 warranty included in your sale, and 8,500 accounts. That has to create crazy volume. How does that work?
Yeah, it's a customer service. It's like training day. Every day our customers have high expectations. They need their cars. They have high expectations because they can't afford for their car to be broke down, and it causes their whole, as you guys know, their whole life can get turned upside down if their car's broke down for too long.
Yep.
And then they don't have the money a lot of times, even for a tow bill, much less a repair. So they are high stress. So you need a lot of customer support on the phones, a lot more than I thought. We've got altogether 9 people, 3 in Tulsa, 6 in Oklahoma City, that are warranty advisors and answer the phone and take care of the customer service. And it's full contact. I mean, they are mad, they are upset, and they want it repaired now. And got to have the right people with the right mentality, and everybody needs to understand the situation from the customer's point of view.
Do you have a separate service department that only handles warranty claims, or do you farm those out?
I keep them separate. The problem is that I had is that whenever I had them under one shop, the customer always took priority, because the customer's the one, a lot of times making all the complaining and calling. So we had to separate so that we could also recondition cars and sell them.
And that's you own the service department, or do you have outside service companies doing it?
It's just a department within Express Credit Auto, so it's in-house.
Okay, separated.
Your warranty, do you administer your own warranty, or are you using outside services to kind of field the phone calls and do that?
We self-administer with Buckeye.
Yeah.
Okay.
Yeah, I think honestly, that's the best way to handle it, because even though we own the reinsurance company, it seems that the reinsurance company is going to be a little tighter than we are. It seems like when it comes time to repair.
Yeah, let me talk about that, Shawn, because we love the guys at Buckeye and they sponsor the podcast, but how has that affected you? I mean, I could imagine when you're doing that many accounts and that many sales, and if you're tucking money away into your reinsurance company every single month, that's a huge amount of cash and maybe a cash drain. I don't know. But I mean, what was your philosophy there? Do you use that warranty company to the extent you can to save taxes? Or is it just kind of like hey, we try to run it at a minimum just to keep customers happy?
Well, ultimately it was set up just to take care of the customer, but it has turned out to be a very profitable venture too on the side. But that was a little bit of the unintended part. I mean, of course, we didn't want to run a loss, but even now we could seed more, and we're looking at that because what we're seeding is below the market rate. But yeah, it's a great wealth building tool. You can have children's or grandchildren's trust own it, give them deferred income off of that, and it's a wonderful tool for wealth management. And there's more ways than we have time for to use it.
Sorry to break in, but as we will hear, one of the major changes in Shawn's whole business model was providing warranties for customers. And Jeff, we've got a company that does it. Buckeye Dealership Consulting, one of the best in the industry, if not the best in the industry when it comes to getting this taken care of.
Yeah, and if you're in buy here, pay here, and you're giving the customer some sort of a guarantee or warranty on their car, I did it for years and years and years, right? And I just thought, hey, I'm just going to self-fund this. I'm just going to call it a warranty, but I'll just keep it in my slush fund. I don't want to set it aside. It really doesn't make a lot of sense, because
it doesn't make sense.
You have the opportunity to expense that dollar amount, whatever it is, $300 a car, $400 a car, $800 a car, expense that out and set that aside into your separate reinsurance company.
And it will change. It will change your life. It may change your grandkids' life. And it'll change the trajectory of your business, because once you start doing that, customers understand that they are buying value.
Yeah, they're getting value and you're getting value, because it's like a forced savings account. It's like your Dave Ramsey plan to put a little money aside every single month for yourself in the future, and it builds and builds and builds and builds. And in 20 years from now, you got a couple $1 million sitting in your offshore company. So get with the guys over at Buckeye and get your reinsurance company set up.
Sure, Shawn. And what year did you start your reinsurance company?
You know, I was one of the first. I believe I was the first one that created the included warranty for buy here, pay here. I did that with sidecars back in, probably about 97.
Oh, wow. Yeah, definitely a
And
forerunner.
they did not, all they had was service contracts back then, everybody. And I had this idea of a included warranty rather than a service contract. And I contacted Paul, I can't remember his last name, but Paul DeGrego or something like that at Sidecars. And I pitched him my idea, and he went to work on it. And the birth of included warranties for buy here, pay here customers was created.
Well, I know there's plenty of customers out there that should be thanking you because and plenty of dealers there too, because I mean, that really transformed our business. I remember, I think we started including warranties, I would think in probably 07, 08. And in our area, that was, I mean, it was pretty dramatic. And I think it started like maybe with a 30-day warranty because we were doing it anyway. And I'm sure that's how yours evolved. And then then we moved to a 3-month, and then I did move to a 36-month, and I drew it back some. Has yours evolved like that? Or have you been at 36 for a long time? How does that look?
Well, I was at 12 for a while, and then I bumped it up to 24, and I just kept seeing repossessions come in, 1 year in the purchase, 26,000 miles on them, and the customer would assume that we wouldn't help them. And we'd get a hold of the customer after the repossession and say, hey, we saw that their motor's out. Maybe that's why you let it go back. We'd like to work with you. And then the customer typically would say, well, I didn't think you would. They're making assumptions, and they went and bought a car somewhere else. So because of that, is why I went to the 3-year 36. Most of the time it works out to be about 18 months to 2 years for most customers, not the 3 years. There's a few, I mean, I shouldn't say a few, but a smaller amount that does go the 3 years, but it's not as often as a dealer would assume.
And did you see a jump in your collateral recovery rate at that point, or a decrease in your repossession rate?
Yeah, we did. We had a decrease in our repossession rate and happier customers. That was really kind of the start of where we are today as society. It's like, why would we do something good for the customer, and have tools available and not tell them? And that's where the industry was years ago, to where it's like, hey, well, if you would have called me, I would have policy expensed it or whatever.
Yeah.
But our customers need to know their resources.
Yeah. Shawn, I want to ask a little bit about your business model as far as your deal structure goes, because I find it so interesting to be doing buy here, pay here on, cars that range from 12, 13 grand up to 30, 40 grand. Like, I think if some of us dealers hear the fact that you are carrying the note on a $20,000 or $30,000 Dodge Ram, they would just blow their minds that that's even profitable. How do you make that work? I mean,
he's got a $48,000 Chevrolet truck on his website right now for buy here, pay here. Let's talk about that deal, Shawn.
In that example, what kind of, I mean, are these people coming in with 10, 15 grand down and they're paying $2,000 a month, and you're making, maybe help walk us through a structure like that? How does that make sense?
Well, we're not very much on deal structure unless it's a high risk, low value car. High risk customer in a low value car. That's where we get the bigger down. I might only get $300 down on that $48,000 truck because that's going to be a subprime customer. It's not going to be a deep subprime customer that buys that truck. So we're after the customers with the 600 FICO, the 625, the 650 FICOs. We're after those customers too. We have tiered interest rates. We have interest rates as low as 8.98%. We go 60 months or a little bit more sometimes to get the deals done. But I like that business is more profitable and less work than the $6,000 to $8,000 wholesale ACV car.
Yeah,
I imagine
I've seen that. Yeah.
The full coverage insurance component is so crucial. Or do you do that, or do you have a CPI product? Because I don't want to. I mean, that would scare me to death to have a $30,000 or $40,000 car, even if it's an A credit customer. They can still let their insurance lap and total it out on a Friday.
Yeah, we don't verify insurance at the time of sale. We assign every customer to collateral protection and then allow them to send us their insurance after the sale. And if they provide it within before their first payment is due, then we remove the collateral protection. So we just take the risk. And there's many times to where maybe there's some time without coverage technically because we force place the collateral protection, but then we're not going to charge them for it.
Yeah.
So sometimes they get, 7, 10, 15 days for free. And we just take that risk.
So on a car like that, for a guy like me who's looking at like a cash return, when you sell a $20,000 or $25,000 truck ACV, I mean, you really can only mark that thing up still $3,000 to $4,000 maybe, right? I mean, you're definitely not doing a similar model like with me, where if I sell a $6,000 car ACV, I can almost sell it for twice, $10,000 to $12,000. I can make about 100% markup. Obviously, in those higher end cars, the markup's not there. Does that?
Well, it's more than 3,000, Jeff. I promise you that.
Yeah, it's more than 3,000. We have a flat markup, basically, or a flat range of a markup between $5,000 to $10,000. So if we get a steal at the auction and it's a higher ACV vehicle, it could be marked up $10,000. On the low side, it's $5,000 markup. But it's just kind of a per unit, where the market's at, what kind of buy we got, but typically the higher ACVs we try to get $7,000 to $8,000 of a markup.
Shawn, what is your average, if you know this, what's your average monthly payment when you look at across your portfolio, and how much have you seen it going up in the last, let's say, 18 months?
We haven't been tracking that. I'm a little bit light on staff, and we haven't tracked that in probably 2 years. So I'm not for sure where I'm at right now, but when we were tracking it, it was about $110 a week.
Okay. And on these really high end, I mean, are people paying $1,000 a month? I mean, does that happen?
Yeah. I mean, that's where it kind of stops though, a lot of times, but on a monthly payment. But typically, if it's biweekly, it could be $4.99, $5.99 biweekly sometimes. But they have we budget everybody out and make sure they can afford the payment.
It seems to me like I guess I get tripped up on the fact that I feel like as I creep up in ACV or as I creep up in credit tier, I'm getting a more price conscious shopper. So I'm not able to mark up that car as much because now maybe they have more options. And so they're shopping my car against the one at the new car store who's only trying to make $1,000 on the front end and then another $1,500 on the back end. And maybe they've got some crazy bank that'll carry a 600 credit score, or 620 credit score or something. So do you end up competing on price as you start creeping up an ACV and credit tier?
I don't look at that. I don't even consider it.
I think
but I think, the thing is as you have nicer vehicles, you are going to attract more non-buy here, pay here customers to your location. And those people are going to be more price conscious. But they're not our customer.
Yeah, that's interesting. They're just not our customer. And sometimes we find that at our dealership that, hey, this customer's trying to buy this. Well, honestly, they don't fit our box. and they may be fine people and may pay perfectly, but that's not our customer. And when they come and look at, they're looking at your car, and they came there for a reason. They can see the price on your website. So, I think you're right there.
Yeah.
What, Shawn, what's the one thing you've done in the last 25 years that was the exact right thing, and that you want people that are trying to learn to build a operation like yours? What is that one thing that we should all do?
We should all warranty our cars.
And you think that changed the dynamic of your business, do you believe?
Yeah, it definitely did. Especially whenever I was in the lower ACV model period. Sometimes we'd have cars, quite often we'd have cars with 120, 140,000 miles. And that gave the customers a reassurance to go ahead and pull the trigger and purchase the car.
Mm-hmm. And I believe you're talking about like a limited powertrain warranty, right?
Well, our warranty is limited, but it's powertrain plus.
That's what ours is. Yeah.
Yeah, I mean, it's we got to keep the cars running. I mean, it's no different than a landlord having a home with a clogged toilet. They're just going to do more damage to the home, and they're not going to want to make their rent payment. It's the same thing in the car business. Or buy here, pay here dealer. If the car's not running, they're not going to pay. So we got to keep the cars running, and we need to have enough profit in there so that we can afford these policy expenses.
Mm-hmm. So your advice to dealers would be warranty their cars, provide it for free, stand behind your product, especially in the buy here, pay here. Do you have something that you did that was just you would say a bonehead move? Can you think of anything in your past where you said, man, guys, I stepped on this landmine. This is what I would tell dealers to not do?
Overspend digitally. Google and Facebook will take all of your money and tell you why you need to spend more. Mm-hmm. And so don't trust those algorithms. Don't, if you are spending a lot digitally, get a consultant or somebody else that can manage those funds, even if it's, a lot of times it's $1,500 to $4,000 a month. You got to find the one that fits your budget, but they'll save you a lot of money and it'll perform a lot better than doing it yourself.
And what do you think? I mean, your size operation, I'm sure you're spending a ton of money on marketing. Is it for someone who's, not as big and, a normal size operation, how do we decide what that right number is, Shawn? I mean, is it per car sold? Is it per lead? How do you judge that?
Well, I would be out there on Facebook. The small dealer actually has more of an advantage because they can create more fresh content for Facebook and Instagram. They can focus on that and it'd be locally for one or two locations, so it'll be more relevant. It's really that social media. They need to be really good and really understand social media content, how to create it, how to post it. And if they don't, they need a consultant to do it for them and help them with it. And then referrals. Ask for a referral. Who do you know that's going to be buying a car next? And so ask referrals and ask for it correctly.
And do you have a referral program where you pay customers that refer, or how do y'all handle that in house?
We do. It's not a lot of money. It's $200, and they get it posted to their payment, so it reduces their payment for the next time. So it's just a little thank you, but mostly it's just doing good business and asking for referrals. It's that, because we are the local community dealer. So we're not going to be able to get the impressions on TV that Drive Time does. We're not going to be able to be a better digital advertiser than Drive Time, but we're in the we're in the grassroots, and we can execute a lot better.
So true. And Shawn, I want to point out one thing before we close here. You had mentioned that in 2000, just before 2000, you were living with your wife in a trailer, starting your buy here, pay here. Fast forward 20 years, and 20 years is not a long time. I mean, really, like, for any of you guys with kids, 20 years goes real fast, right? I imagine you're not living in a trailer anymore.
No, but I'm probably not living in as nice of a house as everybody thinks. I still have my tightwadness, like I'm driving a lot vehicle and, but I'm just being me. A lot of people try to tell me what I should be doing with my money and how much I should be spending of it, but I'm just being me. And I'm more of a saver than a spender.
Well, Shawn, that I think a great way to wrap it up, because to be a true buy here, pay here dealer, one that starts it from the bottom, you have to save, you've got to reinvest, you got to pay your taxes, you got to do all this. And I think Shawn is the epitome of what, anybody that wants to be a really successful buy here, pay here dealer, you're the way that we need to go, I think, Jeff.
So glad you joined us. Please take a minute to leave us a review and share this podcast with a friend. The Independent Dealer Podcast. Dealers helping dealers.